Welcome back to another episode of Market Brief After Hours. It's great to have you with us as we break down a truly fascinating start to the new month. If you were watching the screens today, you saw a real split-screen moment. On one side, you had U.S. equities absolutely surging, looking confident. On the other side, chaos in commodities and crypto.
It really was a tale of two markets. It feels like investors just decided to put blinders on regarding the turmoil in gold, silver, and Bitcoin, and instead focused entirely on the corporate earnings sheet and the economic data. It's a classic risk-on vibe for stocks, but a definite risk-off, or perhaps just profit-taking vibe for the alternative assets.
Let's start with the headline numbers from Wall Street, because that's where the optimism was centered. It seems the Dow Jones really set the pace today.
It certainly did. The Dow Jones Industrial Average was the heavy lifter, surging over 515 points to close at 49,408. That's a 1.05% gain. To be precise on the index level, we are looking at 49,408. It's a very strong psychological start to the month.
And the broader market joined in?
Absolutely. The S&P 500 posted a solid advance as well, rising 0.54%. It settled at 6,976. What's interesting there is that the buying was supported by major tech and consumer names. Amazon and Alphabet were doing some heavy lifting. And then you have the Nasdaq Composite, which also extended its recovery. It gained 0.56% to close at 23,592.
So fairly consistent gains across the board. But I noticed the Nasdaq had a bit of internal friction. It wasn't a green light for everyone, was it?
No, it wasn't. While the index was up, there was a rotation happening. Nvidia, for example, slid nearly 3%. There are reports swirling about stalled investment plans there. But generally, the mega caps provided enough support to keep the index in the green. The market is really trying to figure out valuations on AI spending right now.
One of the big drivers for this equity optimism seems to be the economic data coming out of the U.S. manufacturing sector. We saw some numbers that I think caught a lot of people off guard.
Off guard is putting it mildly. The ISM Manufacturing PMI was the star of the show. It jumped to 52.6 in January. Now, to give you context, it was at 47.9 in December. Most analysts were forecasting a modest 48.5.
And for our listeners who don't watch PMI daily, that 50 mark is the magic line, right?
Exactly. Anything above 50 signals expansion. This is the first time we've seen expansion in 12 months, and it's the strongest reading since 2022. New orders, production, supplier deliveries, everything improved. It suggests the U.S. economy is far more resilient than the bears were betting on.
That resilience usually impacts the bond market. Did we see movement in treasuries?
We did. When growth expectations go up, yields usually follow. The 10-year Treasury yield climbed to 4.283%, and the 30-year moved up to 4.914%. It's a sign that the market is pricing in better growth and perhaps recalibrating what the Federal Reserve might do next.
Let's hop across the Atlantic. It wasn't just a U.S. rally. Europe seemed to be in a good mood as well.
Europe definitely joined the party. The Pan-European Stoxx 600 advanced 1%, recovering from some earlier weakness. If we look at the specific hubs, London's FTSE 100 actually outperformed many of its peers. It climbed 1.15% to settle at 10,342.
In the mainland?
Strong showing there too. Germany's DAX rose 1.07%. The French CAC 40 added 0.79% to reach 8,191. But the standout was actually the Swiss market. The SMI recorded a robust gain of 1.67%, closing at 13,409.
What was fueling that European optimism? Was it just drafting off the U.S., or was there local data?
A bit of both, but there was a surprising bright spot in the data. French manufacturing expanded at its quickest pace in nearly 4 years, with a PMI of 51.2. Plus, German retail sales surprised to the upside with a 0.1% increase. It's a glimmer of hope that the consumer is hanging in there.
Now, while the West was rallying, the session in Asia was, well, let's call it dramatic.
Dramatic is the right word. It was volatile. The headline story is South Korea. The Kospi index plunged 5% to 4,950. It actually triggered a temporary trading halt.
That is a massive move. What caused the floor to fall out?
It looks like intense profit-taking in the semiconductor space. You have to remember, the Kospi surged 24% in January alone. So this is a pullback, but a violent one. SK Hynix fell almost 9%, and Samsung was down over 6%.
And elsewhere in the region?
Japan's Nikkei 225 struggled, shedding 1.25% to close at 52,655. Hong Kong's Hang Seng dropped over 2%. However, India was the outlier. The Nifty 50 climbed 1.06%, supported by a very strong manufacturing PMI of 55.4. So India is bucking the regional trend.
We are going to take a very short break. When we come back, we need to talk about the commodities crash, gold, silver, oil, and we'll dive into the technicals on the currency markets. Stay with us. Welcome back to Market Brief After Hours. Before the break, we talked about the equity rally. But if you are holding commodities or crypto today, your portfolio probably looks a lot different. Let's start with the shiny stuff. Gold and silver took a beating.
They really did. It was a sharp correction. Gold settled at $4,667. That is a 4.66% decline in a single session. It traded in a massive range, dropping from a high of nearly $4,900 down to around $4,400 before stabilizing.
Is the bull run over?
Technically, the long-term trend is still bullish. Gold managed to find support just above its 50-day moving average, which is sitting at $4,469. As long as it holds that dynamic floor, this is viewed as a correction within an uptrend. But if it breaks 4,402 decisively, we could see a deeper drop.
And silver?
Silver had it worse. It closed at $80.06, down 6.15%. It was a shakeout. It briefly dipped below its 50-day simple moving average at $74.26, but recovered to close above it. That recovery suggests there is still demand at lower prices, but the selling pressure was aggressive.
And then there is oil. Prices sliding there as well.
Yes, crude prices fell sharply. Brent dropped 4.21% to $66.40 per barrel, and WTI slid almost 3% to $62.25. This was largely driven by easing geopolitical tensions between the U.S. and Iran, which reduced the fear premium. Plus, a stronger dollar always weighs on commodities.
Speaking of the stronger dollar and crypto, Bitcoin didn't escape the red ink either.
No, it didn't. Bitcoin remained under heavy pressure, falling below $80,000 for the first time since April 2025. It was trading around $78,234. That's a drop of roughly 12% over the last 7 days. We are seeing deep outflows from digital asset products, about $1.7 billion in weekly withdrawals.
Let's shift gears to the foreign exchange markets. I know a lot of our listeners trade the majors. With the dollar strengthening, what are the charts telling us? Let's start with the euro.
The Euro USD pulled back, closing at 1.1789. It was down about 0.5%. It encountered some selling pressure that cooled off its recent rally. However, technically, the bulls aren't out of the game yet. The pair is still positioned above the 50-day simple moving average of 1.1709.
So 1.1709 is the line in the sand.
Essentially, that 50-day SMA is keeping the medium-term bullish bias in play. Immediate support is at 1.1770. If it holds there, we might see a retest of 1.1900.
What about the British pound?
Sterling entered a consolidation phase. GBP USD closed at 1.3665, down just slightly. The technical backdrop here is actually quite robust. The price is trading significantly above its 50-day SMA, which is down at 1.3430. The sequence of higher highs is still intact.
So buyers are still in control there.
For the medium term, yes. Immediate resistance is at 1.3715. Bulls need a sustained period above 1.3600 to build momentum for the next leg up.
Let's look at the yen. USD JPY has been volatile.
It has. USD JPY rebounded, rising 0.51% to end at 155.54. It staged a recovery after testing support near the 100-day moving average at 153.87. However, it's currently capped by the 50-day SMA at 156.28.
So it's sandwiched between moving averages right now?
Exactly. It's a battleground. For the recovery to gain traction, bulls need a daily close above that 156.28 resistance. If they fail to hold the 154.55 level, we could see a retest of 153.00.
And finally, the Swiss franc.
USD CHF staged a sharp rebound from multi-month lows, closing at 0.7795. But don't get too excited if you're a bull here. It remains firmly in a long-term bearish trend. It's trading well below the 50-day SMA of 0.7941 and the 200-day SMA of 0.8034. This looks like a corrective bounce within a broader descent.
Before we wrap up, let's hit the market movers, the specific stocks making headlines today. We mentioned the broader indices, but some big names took a hit. Disney was one of them.
Yes, Disney shares tumbled more than 7%. The issue there is tourism. They warned that weaker international travel could weigh on growth in their domestic theme parks. They actually beat fiscal first quarter expectations, but the market didn't like the forward guidance on park attendance.
We talked about Bitcoin dropping, and obviously that dragged down the crypto-related stocks.
It was a sea of red there. Strategy, the Bitcoin treasury company, slid nearly 7%. Robinhood plunged 9%, and Coinbase fell more than 3%. It's a direct correlation. When Bitcoin falls 19% in a week, these stocks are going to feel the pain.
Lastly, Tesla. Always in the news, but down today.
Tesla slipped 2%. There are two things happening here. First, reports that Waymo is seeking fresh funding at a $110 billion valuation, which intensifies the autonomous driving competition. Second, reports that SpaceX might combine with XAI ahead of an IPO. That raises questions about Elon Musk's capital allocation and focus, which always makes Tesla investors a bit nervous.
It sounds like we are in for an interesting week. We have a heavy earnings calendar ahead, and clearly volatility is not going away in the commodities or crypto space. That is all we have time for today. If you find this useful, please follow Market Brief After Hours so you never miss an update. Thanks for listening.